In this video, we will look at the 5 things that happen during a recession and how you can be prepared for all of them.
Markets around the world have dropped.
Inflation, GDP,
The unemployment rate.
Cutting interest rates later this fall.
recession.
So, should you start selling all of your investments? Will you lose your job? Are prices going to skyrocket? No, stop. These kind of headlines only want you to click in order to make money out of your fear and emotional behavior. Let's analyze what will actually happen when a recession hits and how you can be better prepared with data and critical thinking. So first things first, what is a recession? The US government wants to overcomplicate the definition of a recession by using more variables like unemployment and business activities and inflation, but it's simply 2 consecutive quarters when you have the economy with negative growth rates. In the simplest of terms, in plain English, 6 months in a row where the US economy has produced less stuff overall. So the first thing that will happen is the change in interest rates. As you can see in the graph, we have 5 different recessions that happened in the past. We have the COVID-19 recession, we have the Great Financial Recession, we have the dot-com recession, the Gulf War recession, and the recession of the early 1980s. What we usually see, and we can see in the graph, is that as businesses are going to have a tougher time, usually the government and the Federal Reserve tend to have an expansionary monetary policy, which means they want to print more money, they want to make it easier for you to have money to spend so businesses don't go out of business, and because of this, interest rates tend to go down. But one of the key differences we have to mention is that you can see that overall interest rates are pretty low compared to the last 30, 40, 50 years. So it doesn't mean that we will go back to the almost 0% interest rates of the COVID-19 era. But we can assume that when recession hits, the interest rates will go down because the government needs to stimulate the economy, as you can see in the red animation in the graph. The second thing that will happen if a recession comes is the collapse of the stock market. And by collapse, I don't mean the total collapse of the stock market, but a significant decline of prices that will make the stock market have lower or negative returns compared to previous years. It is pretty reasonable to believe that when a recession hits, the stock market will go down because of how humans behave, because of fear, because of psychology, and also because businesses will have lower earnings. So if you see the graph, not only are recent recessions making the stock market go down, but they are going down by higher margins. So for example, in the Great Financial Crisis, we see a huge decline of the stock market as well as the COVID-19 pandemic. But if we compare that to the other 3 recessions, it looks like it hasn't changed that much. This may be because of the scale of the graph that makes you believe that the decline wasn't that big of a deal, but also it could be the fact that we have more institutional investors, more individual investors that have changed the market dynamics. So we cannot assume that the next recession will make a huge decline in the stock market, but we have a high certainty and a high probability that it will go down. By how much, we cannot know. The third thing that will happen when a recession hits is the change in the unemployment rate. This is one of the most important variables to look out for, because if you are a business owner, you must acknowledge the fact that it will be more expensive for you to have as many employees as you have when you are not in a recession. And if you are a worker, well, you have to take into consideration that you may lose your job because of a recession. And we have seen during the last 5 recessions a huge increase in the unemployment rate, which is pretty obvious when you are in a recession, when the economy is slowing down, then more people are going to lose jobs. And you can see that during the last 2 recessions, the COVID-19, because of its extreme nature, you see a huge spike, and it will not be very probable that that will happen again. But if we see during the Great Financial Crisis and other long recessionary periods, we have a huge spike in the unemployment rate. Fourth, the number 1 enemy of all Americans, inflation. Most Americans are living paycheck to paycheck because we have seen huge increases in the cost of living. Some families are having 20%, 30, even 40% increases in their cost of living because of inflation. So what will happen during a recession with the inflation rate? As we have seen, the inflation tends to go up when the government starts printing a lot of money and when you have low interest rates. And as we have seen in the interest graph, it will be most likely that the interest rates will go down and thus inflation will rise. But an interesting thing occurs during the recession because you have less earnings, less business, less movement in the economy. The prices go down because people are not buying, so you have an excess supply in the economy. So it is not intuitive to believe that with lower interest rates then inflation is going down. It is the only scenario most of the times where you have that kind of nature. So if a recession hits, do not be surprised if some bills will go down because of it. Finally, we have the GDP, the production of the economy. Most economies like to use the growth rate in order to see if an economy is doing great, bad. But if we see in nominal value, what has happened to the US economy over the period of time from 1980 to today, we have seen that there is a clear upward trend of the economy. And during recessions, you see a decline, which is obvious because that's the definition of recession. But the funny thing is that most headlines, most news outlets want to creep you out that the recession, it's a huge deal that will change the world forever. What you have to do is zoom out a little bit. Look at the graph. During those recessionary periods, you see obviously a red animation that is going down, but it's not as big as you might imagine. And that's the beauty of data and looking with a graph what the data is trying to tell you. And even though because of scale, it might not look as big of a deal, you can see that afterwards the economy goes back to normal and you have growth normally. So now we know the 5 things that will most likely happen. And I can already read the comments that is saying,
past performance doesn't translate into future performance.
And that's true. The fact that it has happened in the past is not a good enough reason that it will happen in the future. But the past is the only thing that we have, the only data that we can analyze in order to have a picture of what would happen most likely in the future. So if we want to get prepared, the only means we have of that is analyzing what happened in history, and learning from our mistakes will make us be better prepared for what the future holds. All historians say that history repeats itself, and we have seen many historical figures that have lost wars and money because of not learning from that history. So now, how can we prepare? First, interest rates. Interest rates will likely go down in order to stimulate the economy, as we have seen, and get out of a recession. So if you're planning to buy a house with a mortgage, it will most likely be cheaper to start saving that down payment in order to take advantage of a lower rate. Also, credit card payments with adjustable rates will likely go down, so make sure to pay any debt you have and don't get tempted to spend more money you have because rates are lower. With lower interest rates, an interesting thing occurs, which is businesses have cheaper means to raise capital and debt to expand their operations. So even though we have seen that stock markets tumble during recessions, if you have a strong and well-managed firm that will take advantage of this cheap money, you can have great opportunities to buy stocks that are not only oversold because of fear, but also have a great growth potential because of cheaper cost of raising capital. Third, how to prepare for the unemployment rates. As we have seen, businesses will try to survive the recession by firing most of the times thousands of people. And maybe that unlucky one could be you. So make sure you have an emergency reserve of 3 to 6 months of expenses. So if it turns out to be you, you are covered for that time and you will be able to look for a new job with less stress than not having that emergency fund. Fourth, inflation. Things will get cheaper to buy because people are not buying, as we have said. And as you have opportunities with stocks, you can find attractive bargains in any market as well. If you want or need to buy something, you may find pretty good deals. Remember, it's a good reason to buy things you know you can afford and that you need or want in the near future. But don't overspend just because it's cheaper. If you want to spend money, do it by investing in stocks and index funds for your future. Finally, how to prepare for an economic slowdown. You know businesses will suffer before going back to normal. If you are an entrepreneur or small business owner, do not be discouraged. These tough times are when great businesses emerge. And if you make it alive when your business is going through tough times, then your business is robust enough to survive anytime, good or bad. Do not fall into the trap of getting emotional or scared by news outlets. You will be better off financially and psychologically when you start assessing things with data and critical thinking like we have done today. If you're curious to know how the best entrepreneurs in the world are not millionaires and how you can be the exception, click here to find more.